Hey, we have Mike Hajjar with us today. Nearly 2 decades of experience as a trusted mortgage professional loan officer. He's a leader at Landmark Mortgage Planners. I mean, he started when he was 18 years old, and you can see he still looks young. And you know what? He's helped over 2,500 families achieve their home ownership dream, ensuring support before, after, during. Mike's also the founder of MPH Legacy Group. Mike collaborates with financial professionals to offer alternative investment solutions and strategies. Through his podcast, The Financial Rebound, he shares his journey of overcoming a seven-figure debt, rebuilding a financial life, helping others avoid common pitfall. Mike also serves as an ambassador for First Home IQ, a nonprofit focused on providing Gen Z with essential financial literacy. You know what? We're lucky to have you here, Mike. We've got a big thing, big subject going on because the study just shows 88% of people love owning a home. But the big issue here is we've got the mortgages and all the costs and stuff that goes along with that. It's one of the reasons why we have you here today. You know what? We're going to talk about 2024 in the mortgage world, what we have to expect for in 2025. But then, you know what? Our listeners and viewers, and, you know, they're between, 45 and 75. But you know what? They're worried about, what do I do if I'm getting a mortgage for the first time? What if I'm refinancing? You know what? I've got this variable mortgage. How do I deal with that? Because rates keep flying up. And you know what? What are the little tips and things that people need to know how to properly get prepared? All that lovely stuff. And we got some time to unpack it. So with that, Mike, thanks for being here. Appreciate it.
Thank you so much for having me on. It's a pleasure to be here, and I'm excited to jump in with you.
Well, let's first talk a little bit about your story, because when I was reading overcoming a seven-figure debt, $1 million is a pretty big debt.
Multiple seven figures, so it was not it was not a fun time in my life, but a necessary one. Lot of lessons that I believe that were preparation for the things that I was gonna go through later on in my career, right? And whether that be in life and or in business, I think there's really we say this, adversity is our biggest currency, right? One of our most valuable teachers. So while that was not the most fun time of my life, I wouldn't change a thing in regards to how we went through it.
Well, I actually think that's important because um, it's in the failure where the gain is. Just like you said it differently, but it's in the grind and it's in the failure, it's in the grind and the achievement that you learn from those things. So I think that's wonderful. So I got to ask, what got you in the mortgage business at 18?
So I was contemplating going to college at Michigan State, and my buddies were all there. And in all fairness, probably like junior year of high school, because my friends were, my age and then a couple years older. So I already had some of my friends in college, but we were already, heading out on Thursdays to Michigan State to go party with our buddies and whatnot while I was in high school. And I started to think, I'm like, all right, all my friends are there. Am I actually gonna like focus when I'm in school, or is this gonna be like a huge party? And I didn't want that money to go to waste. So I got one of those phone calls. One of my family members was in the mortgage business back then. He still is, and he called me and he said, do you want to make $10,000 a month? And at 18, $10,000 a month is like, I think I'm like King Kong or on top of the on top of
A
the world
billion
at that
dollars.
point. Exactly. So I decided to do that and go to school locally. So I was trying to balance the two. And in my junior year was where I decided that I was going to go full time into the mortgage side, because that was my junior year would have been the 2008 crash. So not only was I severely immature at that point, but I needed to find other ways to make money. So we started flipping some real estate, and there's houses that are. Had I held on to them, would have been awesome, but I needed the money. We were buying them for like $17,000 to $20,000. Those houses are worth about $250,000 to $300,000 today. So I was getting heavily into that, and really, I tell people, like, for most people, um, once the mortgage industry gets its claws in you, it's kind of hard to get out. And because there's those months that we have no limit on what we're able to do, and just that ability to continue to serve people is just was always fascinating to me.
Oh, that's cool. That's cool. That's cool. So, um, well, I get it. Once you get started in something and you really know it really, really well, and you realize you're making more money than your buddies who just got out of college, and you probably will make more money than your buddies for the first 10 years of their career, and you're like, why? But the thing is, you already had the lessons that got taught that could have got taught in college. So I think that's very, very cool. Because quite frankly, most people don't know this about me. I have a degree at Pepperdine, but I
Oh,
actually didn't get
nice.
that. I didn't get that degree until after I was already an executive for a company.
I
They said,
love that.
"Oh," they went, "Oh crap, you don't have a degree. You better go get one. We'll pay for it. Everyone in your level has one, so you better go get it." So, I understand that. I used to develop business overseas, and I had a great mentor. So you're very lucky with your uncle. So that's very cool. Very cool. So let's talk a little bit about the mortgage market in 2024 because we started seeing interest rates go up and all that kind of stuff. So help everybody understand what that, what was taking place.
So in regards to rates, I think there was a lot of anticipation of rates coming down into the fives this year. A lot of forecasting around that, and as the uh, economic reports were starting to come out, more and more we started to see that probably we're gonna be more like in the mid sixes for the rest of the year. Now, again, new administration comes in. I think that causes some different sort of pros and cons in the market, right?
Mhm.
Regardless of the administration. And um, I think there's a lot of things happening behind the scenes right now where um, I think 2020 there was over 400,000 licensed originators, and we are down to about 135,000, and we would potentially see another 30% exit the industry this year. What does that mean for home buyers and homeowners? The people that are staying in, you're going to see sort of um, the cream of the crop sort of rise. And that's not like a patting myself on the back thing. That's a lot of resilience, right? I didn't take a paycheck for 12 months last year to make sure that our team was properly staffed for what we were going to deal with this year. We've never been my in my early career, I was heavily on the consumer direct side, scaling those teams. But for the past 7 years, we've been focused on primarily purchase business and not losing sight of that. And so, really, what I think it's gonna mean to home buyers, I think there will be a little bit open up of supply, because people are just accepting, hey, this is where rates are going to be. I know there was a lot of that talk about marry the house, date the rate. I think that's a dangerous term, because you can't qualify people based on what we think is going to happen in the future, right? We need to make sure that that affordability is there today, along with adjusted for inflation and the rise of property taxes and things like that. So I think, again, what that means to home buyers is it's going to be easier to seek out professionals who are going to have more of a holistic approach rather than just a transactional approach. So I'm not just trying to be overly optimistic. I think there's going to be some opportunities in real estate that just haven't been there for the last 2 years.
So basically, what you're saying is the marry the house, date the rate. That might not be in somebody's best interest because they're going into something thinking they're going to be having a real tight budget right now, and that tight budget might be forever. So it
Correct.
doesn't make a lot of sense hoping on, hoping. you should do the right thing at the beginning. And with the purge in any industry, even mine or ours with the podcast, you
Sure.
know what? It's brutal. The people who were hoping the phone rings, aren't going to be around. The people who didn't get good advice aren't going to be around. The people who don't have a good situation and really truly help people aren't going to be around, and because people just won't deal with them anymore. And I think that's a great analogy to say, hey, look, folks, we're going to be talking with more Mike. Sit with us. We'll be right back with more Saving with Steve. That was perfect. That was a good start. I
Love
love
that.
Mike.
Sorry for the long-winded
No,
thing.
that was actually perfect because our viewers love that. Um,
Okay. I'm trying to
so,
drive it back to homeowners. There's a lot to unpack with with what's going on right now.
you know what? Everybody loves your story. That's what they want to hear. I mean, if you had a cat that came across the screen, they would love that too. We had that a cat or a dog, I don't know, but it's just something out of the ordinary like that works. But the
Right.
story is the thing that really makes life big for our show.
Love it.
Um, and just remember, our listeners are 86% female. I'm not the guy with the radio face, so I am the guy with the radio face. But you know what? I don't know why, but you know what? They like that. So next, let's start walking into. Um, okay, we already did that. All right. Okay. Let's. The big thing is well, you'll follow along. You've been doing this before, so I'm going to go ahead and kick it in. And hello, welcome back to the Saving with Steve show. I truly want to thank you for tuning in and appreciate you for just sharing us with your friends and family, and your associates. I mean, we're over 750,000 here in the States and another 120 overseas, and we just appreciate you. And all the replays are available at savingwithsteve.us. If you're enjoying the stories of helpful information, insight on Saving with Steve, like here today with Mike, I encourage you to subscribe to our YouTube channel so you never miss a show. Check out a few of our affiliates at UK Health Radio, BBS Radio, Talk Radio New York City, E360 TV, Las Vegas TV Network. They're all these networks are dedicated to empowering you to solve problems, uplift your spirit, and live a life of personal and financial freedom. You can also go to the Saving with Steve Sexton Facebook page for insider information, get all the gifts, replays, all that kind of stuff on our website there. Now, we have Michael here. He's talking about mortgages. We talked about what was happening, his story, what happened in 2024, 2025, what he's looking at. But the big thing is here, hey, with higher interest rates, obviously it's not as easy to get a mortgage, Mike. What are the steps that somebody needs to take? And let's just start with the first-time home buyer, because I think it's different for somebody that's buying a second home or refinancing than the first-time home buyer, because they're essentially establishing themselves. So what would be the process? What's the little inside tips, the steps that people need to take to not have a situation where they're always going back and forth getting more information?
I, I love that question, and I think the biggest thing, um, I can't stress how important it is that you don't have to have 20% down to buy a home. I think the stats are showing right now 46, 43 or 46%, don't quote me exactly, of first-time home buyers are believe that you need 20% or more to buy a home. So when I talk about, or when you mention first home IQ and really empowering Gen Z, and it's not specific to Gen Z. This can be a 60-year-old first time home buyer. And we have a whole nother thing we can talk about really what we focus on in the mortgage planning model. So the best advice I give to any first time home buyer, and when people ask me who are the clients that have the most success, typically, it's the buyers that come to us 6, 12, 18 months beforehand and put together a game plan. So when we say we're there before, during, and after, we're not of the belief that and I'm not knocking any mortgage or real estate professionals, but again, it's dangerous advice to say it's always a great time to buy a home. That couldn't be further from the truth. It's a very unique and individual situation. It is a perfect time to buy the home when the client is fully educated, empowered, and can make a clear decision on whether that's right for them or not, with, of course, our advice. So the biggest advice that I can give to any first time home buyer is, and I think to human beings in general have a challenge. We have a challenge with depth perception. So a lot of times clients will come to us and say, I think I'm 12 months out. It's too far. And we start to dive into that and we start to create the game plan. And that 12 months that they thought was really more like 90 days. And not to say that I don't care if somebody's 2 years out. We're going to still have that conversation. So one of the other things is find a lender that is not going to discount you or bypass you because you're not buying a house tomorrow, right? That we call it desperation cologne and commission breath, trying to force a sale rather than really sitting down and understanding. All right, if we're there before, during, and after for the client, we need to make sure that the decisions that are made today are not only in line with their short term goal of buying the home, but in line with their long term goals of what sort of lifestyle they want to live 20, 30 years from now or 10 years from now, whenever that retirement play comes in, adjusted for inflation. And that's where we would bring in advisors, guys like yourself, just people that can really help consult and build that advisory team around the client. So if a lender is not going to talk to you because you're not buying tomorrow, you've got the wrong lender. I strongly suggest, whether you believe you're 2 years out, a year out, 6 months out, get the game plan together now so that you're ready when you are actually ready. You're fully prepared.
You know what? I think that's great advice because whether you're going to buy your first home, second, fourth, fifth, whatever, or even getting prepared for retirement, the better educated you are and better prepared allows you to go into that transaction with confidence as opposed to a monkey on the back, always wondering if you did the right thing. Did we do too much? All that stuff. You have time to think it through. More importantly, if you have a mortgage professional, a real estate professional, and a financial professional, you have three people providing the advice, giving you the ups and downs, and that way you can make a good decision. Because one of the worst things people can do, and I see this in the financial world, where they're trying to make a Roth conversion decision and they've just got their financial advisor. Or they've got their tax professional and they're telling the tax professional what the financial advisor says, and they can only get half of the story right. And you have this tax professional going, no, but it could be the best darn thing in the world because they don't have the right people on the same page to hearing the whole story at the same time. So I think that's great advice, especially in times when you're seeing higher rates with mortgages, to really understand what's going on and make a solid decision and making sure you get the house that you want. Um,
Absolutely. And
that's
and
that's
and just to piggyback off of that, you couldn't have said it better. So, even on our website, homealoneplanners.com, if you scroll down probably, a quarter of the way of the page, we have what's called the client advisory team that I mentioned, and that is it includes the lender, which would be us, the real estate professional, the financial advisor, a life insurance specialist if the advisor doesn't sell financial products, an estate planning attorney, and a CPA. And we've now also brought in one additional one, a local property tax assessor that helps us, because if I come to you and I say, "Hey, Steve, this is what I think the taxes are going to be next year," or you can come to me and say, "Mike, we need to be a little bit more specific. We're not, just guessing here." But what you said is so important and accurate. I don't know what the CPA knows, and the CPA may not know what the estate planning attorney knows, and all these, and then the financial advisor. But when those professionals are able to communicate, what happens for the client, it becomes life changing. And we, we can get into stories of that another time, but I think you nailed it. That the client can only communicate so much, and that's no knock to the client. I don't know if the CPA tells me. I don't want to be the one to go tell the financial advisor what the CPA said. We should all be on that call together, really strategizing and making sure we're finding efficiency and inefficiencies in the strategies.
Oh, I totally agree. I can. There's multiple times where I've had conversation, and it's not about mortgages, but it might be about planning somebody's income, and they think, you know what? I'll just give you an example of somebody I had the discussion with after they had a conversation with somebody else. And basically, what this individual is doing is the person called him up, all that kind of stuff, and talked to him about doing a life insurance policy. And the guy said, "Hey, $100,000 a year for 3 years." Okay. And it was going to create this $2.5–3 million life insurance policy for his heirs. Okay. And you know what? And then he goes, "Hey, Steve, I need $100,000." I said, "Okay, what are you doing? What are you getting it for?" He goes, "Oh, I'm getting life insurance." Okay, I wish you would have talked to me, but hey, it is what it is. So I have a question for you. You only have IRA money. So do you realize with your income that you have right now with your Social Security and pensions, add that $100,000, you're going to pay $36,000 in taxes?" He
Created
went,
a
"What?"
serious taxable event.
He just went, "What? What?" And it was like you saw the light bulbs go, "Oh." I said, "You know what? And maybe we should get, Karen on the line to make sure that's all, when she got a line, it was actually $40,000 in taxes." And he's like, "Oh, we need, no." I said, "Well, look at that. You're going to have to pay 420, 430,000 if taxes don't go up in order to do the 300,000. Is that something you want to do?" And I think he was just, oh, oh, oh. So, you know what? He actually said, "No, not going to do it," that type of thing. But stuff like that happens all the time. The problem is, if he went forward, did it, and then the tax man hit, he would be like, "Oh my God." But the other thing I didn't talk about is he's over a certain age, and because his income exceeded a certain level, he's going to have to pay almost twice what he would have
Did
to
it
pay for his
create a mess?
Medicare. It's
It
Medicare
created
earnings tax. The Medicare earnings tax, where your Medicare goes up from, we would pay $400 a month for 2 years for Medicare. And he's like, "Oh." It was, I'm not laughing at him, but it's just one of those things where people just don't realize. And it is comical to him now because he's not getting hit with everything. We got everything back, so it wasn't going to get taxed. So, you know what? Those things happen way, way too much. And I think it's important. And I really love the fact that you're saying that you have to have other people on the line because it just makes a lot of sense for that to occur. So, hey, you know what? We need to take another break. Stick with us. We're going to be right back with more Saving with Steve. Cool. I love the way you
love
do
it.
that. I actually checked that out on your website. So,
Oh, did you? Okay.
oh
And
yeah,
and
no,
we
I like to check out everybody because sometimes people have a special niche, and I want to talk about that.
Yeah,
Uh,
so really our focus it would be heavily in line with what you do.
mhm.
I just got back from Orlando. I was at the Circle of Wealth. If you know Don Blanton, Money Tracks, or any of those guys. But it was about 1,500 advisors there, and then it was me and my business partners, which were all mortgage guys. But 90% of what they were talking about is mortgages because that was the number one place that people lose money unknowingly and unnecessarily. So, I love, I'm a big fan of the stock market, but I'm not always just a fan of trying to chase those higher returns. Sometimes it's, you know better than I do, but finding inefficiencies or stopping losses like that could have happened right there. And
Hmm.
we see that all the time. And so what we presented to probably about 100 advisors, that, and this was their 31st annual conference, was all around the misconceptions of the home equity conversion mortgage, the AKA the
Oh,
big
the
bad
HELOC.
reverse mortgage. But we really showed them how to use that as a buffer asset to protect the client's current portfolio. And it's not what I think or whatever it may be. But when FINRA had instigated the study in 2012 by the American College of Finance, it was proven that a HECM earlier in retirement would create 8x cash flow survival. Right, we've got a market down year. We want to let the portfolio recover,
Mhm.
and we'll come pull off of this tax-free growing line of credit on the reverse. Market up year, we'll pull out of the market, let the reverse
Mhm.
line of credit grow. Just called the coordinated withdrawal strategy, but it really protects, especially when we're coming off of a bull
Hey,
run.
Mike, let's wait to talk about that because
Okay.
I was pausing and I do want to have that discussion when we get into the last segment, okay?
Oh,
Because
got it. Okay.
so that's something that's important, very important. So here we go. Hey folks, welcome back to the Saving with Steve show. We're talking to Mike Hajjar here. We're talking about mortgages, all that's going on right now. We just finished talking about having multiple advisors with you when you're making this decision. And more importantly, get prepared 6, 8, 12 months in advance. Don't act like you're wasting somebody's time. If somebody won't talk to you because you're that far out, wrong person to be with. Find the right people who will be working with you because they understand that if they can help a number of people do it the right way without stress, hey, it'll make their life work because you're going to say he's a good guy. And we got a good guy right here with Michael. No,
Thank
so the next thing we want to talk about is this. You know what? We have people that are looking to refinance, and then we have, you know what, the variable mortgage. Um, let's talk about let's talk about refinancing. What should people be looking at with refinancing? Because it's different for a first home buyer to somebody's refinancing, especially since the rate might be, you know what, lower, and now they have to go a higher rate because they need the money.
Absolutely. That's a great question. So I think there's two type of people we can split that up into. Is, let's just say, for purposes of illustrating this, is that let's just say everybody has in this category has a 3% interest rate, right? And if rates are sitting around 6.5%, well, obviously a lot of people don't want to refinance at that point. So to me, there's two type of people that are gonna benefit or could benefit from this advice rather. If it's if you don't have a cap on your income, and you're maybe in a commission business or um, somewhere where you're not stuck with a salary, those people are more likely to tough it out and say, "Hey, I'd rather attack whatever." I think we've broken 1 trillion in credit card debt, right? So we're at all time highs. Um, and those people get it. Maybe they have a monster couple months in whatever line of work that they're in, and they can attack that debt. And we'd advise those people based on what their income is that, hey, in the long term, we don't. It may solve some short term heartburn, but we don't want to see you lose that rate. And yes, we can come in with a HELOC for those people, to preserve that rate. Now,
Okay, so could you tell everybody what a HELOC is?
I apologize. Yeah, a home equity line of credit,
Okay,
and
perfect.
that will allow them to keep their rate on the first, and then they would have a second mortgage that we could consolidate that credit card debt with, and then obviously as they pay that off, they're only paying on the portion that they use. So now that if they need money, they can go in and pull from that down the road, or if they're not utilizing it, then they're not paying on anything if there's no draws.
Okay, so
This
let me add this. If you're looking
Yeah.
at doing a HELOC to take care of credit card debt or any type of overspending, you first want to take care of the overspending issue. The
100%.
reason why I say that is I have dealt with so many people and it has derailed so many retirements of people overspending and then refinancing to pay off the debt. And then they continue to spend, and all they've got is a bigger debt here with the HELOC, and they still have the credit cards back up to $50,000. And there they are, they're
100%.
going, hey, I'm paying double. Why, and they just didn't solve it. So you really want to solve your overspending issue, correct whatever the issue is. Maybe it's a one-time thing, maybe it's medical bills, but just please correct that. Otherwise, you're going to be in a double worse situation.
Very well said. And that's why when we say the before, during, and after, I preach this to my team across the country is that if you're the person in the mortgage world that's only going to show up when there's a transaction, then you cannot call yourself a mortgage advisor, or really, I don't know that you can say that you care so enough. So for us, we have at least two annual reviews with every client because they may forget that we told them, hey, you can't re-rack up the credit card debt or whatever it may be, but just to help them make sure that they're always, just like advisors do, an annual review with their clients. Mortgage professionals should be doing at minimum one, especially in this market, two annual reviews with anybody that they've done a mortgage for. Unfortunately, 95% of lenders disappear right when the transaction is complete. So we pick up a lot of business, really just helping people, even if we didn't do their first mortgage, we were able to come in, kind of help them reposition that and
Mhm.
go from there. Now, the second person is that the refinance would apply to is the person with a 3% rate. Maybe they have a great income, but it's a salary and they're capped. And we start to look at what they're paying in interest and whatnot. And maybe they don't qualify for a HELOC because their scores dropped because of the credit card utilization is maxed out or whatever it may be. Well, now we're just going to come in, and it's a term that you're going to be familiar with, but we're just going to look at the blended rate and say, okay, I know you've got the 3% rate on the mortgage, but when we add up this 60,000 or 80 or 100,000 in credit card debt and we look at the blended rate on these and it's 19%, I don't care what the mortgage rate is, as long as it's lower than 19, which it obviously is lower, significantly lower. Well, that's the only people that it really, to me, makes sense to refinance, because otherwise they're in that rat race of just trying to get out of the interest that's destroying them, right? I mean, you
Mhm.
talk about predatory lending. It's just these credit card rates are
Oh,
are something else.
I want to add to that. I had this conversation with, um, I'm going to say it's one of my son's friends, but he's like 10 years older.
Sure.
And it's a situation that you talked about, and what I don't think he realized, and he lives back east. He does have that $100,000 in credit card debt, but the credit card rates are 21 and to 25. And that's brutal on $100,000. That's on an annual basis, and that's a 30-year thing. And then he's got a $250,000 mortgage that he's paying the 3% on. But if you aggregate it in, he's almost averaging 12% on that whole money. So if he can get seven and eliminate the issue there, a lot better situation. Because the reality is he's, what, quite frankly, I know him. He wouldn't be able to afford that. He would be going defaulting on credit cards and a mortgage at the same time unless it was created. And he basically the people who are working with him forced him in with a counselor to do the checkup from the neck up every 3 months because he does have that spending problem. He's
Fair
got some
enough.
cool stuff, but people.
Fair enough.
Everybody knows that person has got all the cool stuff, but is grinding every single day, and they shouldn't be. And if you really look at your situation and don't get embarrassed by it, but fix it, that's the smart thing to do. And I'm glad you talked about that because you know what? A lot of people are just twisting in the wind out there, not knowing what to do. And if they realize, oh my God, that's the source of my problem, I need to fix this, and I can fix it. Yeah, I'm going to have a higher mortgage, but it's going to be better than swimming in debt for the rest of my life.
Absolutely.
So cool, cool, cool. So let's just talk a little bit about people with a variable mortgage right now. And you know what? They probably got it when it was one. and they went, hey, we're good. We're still two. We're still three. That's good. And the next thing you know, it's at seven or eight or nine. So how do we help those type of people?
So those are, I mean, depending on where their rate is going to fall right now. I mean, I just have never been a fan of adjustable rate or variable rate mortgages, because again, that kind of falls back into that marry the house, date the rate. It's we're trying to take advantage of this short term, and we really are hoping for the long term. Do I believe rates will come down? Yeah, I think it's there's a lot of economic factors that'll decide that, but I think it's going to take time, right? If rates just dropped quickly right now, we'd have a lot more economic problems outside of the
Big
mortgage
time.
and real estate world. So it needs to come down slowly. But I would encourage them to get into a fixed product because I'm not saying that. Again, I'm not saying that rates won't come down, but if it's going to take so long to come down, then we just have to make the calculation and say, okay, you may be at 7.25 variable. Yeah, it might go down to 6.5 in 6 months, but again, there's that might factor. So for anybody in a variable rate mortgage right now, I would strongly suggest at least looking at options of a fixed rate, because the last thing, in my opinion, that should be gambled with is the roof that is over our head.
Oh, totally, totally agree with that. That is, you know what, um, big time. So, you know what, we've got another minute or two with this little segment before we get into the next one. What I'd like you to talk about is things that people need to have prepared if they're going to get a mortgage. What does somebody need to be looking at right now if I'm going to get a mortgage? If I'm looking to get a mortgage 6 months down the road, what should they be looking at?
From a credit perspective, obviously there's loans that go down to a 580 credit score. So I don't want people to just discount themselves because they are hearing somebody on TikTok or whatever these gurus are out there saying. And then also just having whatever their job is, right? Just having the documents prepared in regards to W-2s, pay stubs, if they're self-employed, the tax returns, and then self-employed people, we don't want them to discount themselves either because 95% of lenders, if you've got a CPA who knows what they're doing and legally and ethically is putting write-offs into depreciation and amortization, the average mortgage lender is going to miss that, but the 10% that really understand that know that those things can be added back in while still giving the client the tax benefit, or the tax write-off, if you will. And I'm not giving tax advice. This is
Hmm.
just real life scenario, right? And so not discounting themselves, having the financial in place, and then also just knowing where a down payment, and knowing that again they don't need 20% down, but just having uh, some sort of plan that we would help them create. And I guess I can't stress enough. I don't know how many times I have to stop somebody in their tracks. You'll cringe when you hear this, but the client comes to us and says, "Well, the realtor told me to liquidate my Roth IRA to put the down payment," and we're like, "No, no, no, we got to pump the brakes on that, right?" So just knowing that. Yeah, there is. You don't need 20% down. You can buy a home with as little as 3% down. There are down payment assistance programs that, which I'm not necessarily the biggest fan of going in negative equity positions, but they're there. And more importantly, I would say than anything, and this is why we put the game plan together, is making sure. I know people say like have 3 months of emergency funds. We're recommending our clients have 12 months of payments set aside of whatever their mortgage is going to be, especially in an environment like this with a shaky economy.
Yeah, I think that one of the best things you said there is you gave the example of the real estate person told him to liquidate a Roth IRA. that's the time where you need your financial advisor involved to help you make the right decision so you can utilize the appropriate money that won't adversely affect you down the road. Too many decisions are made today that people don't realize that will impact them when they're retired or when they can actually retire. So, and if you think taxes are going to go down in the future, hey, liquidate the Roth IRA. But if you don't, might be a good idea to continue with that. So, folks, hey, stick with us. We'll be right back with more Saving with Steve and Mike Hajjar. This is wonderful. That's great practical advice.
Thank
You
you,
know how many
man.
times I get I probably get at least 8, 10 phone calls about stuff like that. Well, my real estate person, I said, "Oh, really? Do they have a license to provide financial advice? Are they your CPA?" No.
I mean, it's ruthless. It's not because they don't understand. Of course, they don't understand the ramifications. It's like, so you're just to make a sale, you're going to tell somebody to do what maybe has been years of planning to put into place. And again, while somebody like me and you is thinking like, okay, we want to make sure that decision is in alignment with the lifestyle that they want to live in retirement and whatnot. Well, we can't disrupt certain things that need to be in place. And if somebody needs to liquidate a Roth IRA to buy a home, well, maybe it's just not the right time to buy a home.
Yeah, especially if you don't have that, that means they don't have cash somewhere else. It's just a lot. So here we go. We're going to go in the last segment. What I'd like to do is reiterate how important it is to work with multiple professionals to make sure you make the right decision. And two, I'd like to talk about, hey, look, I heard you're at a conference. Tell me about that conference. Tell me about the issues that they were dealing with that conference, and tell us what you got out of it, and then share that story you're talking about when we weren't recording.
Okay, gotcha.
Okay. Hey, Cameron, we're in segment 4 here with Saving with Steve on Mike on episode 218. So here we go. 5, 4, 3, 2, 1. Hey, welcome back to the Saving with Steve show where we talk about the ins and outs of money. I want to thank you for tuning in. I appreciate you sharing us, letting your friends and family members know about the show. Again, we appreciate it. All the replays are available at savingwithsteve.us. If you're sharing the stories of enjoying those stories and sharing those stories of helpful information, insight on Saving with Steve, then I encourage you to subscribe to our YouTube channel. Never miss a show. Check out a few of our affiliates at UK Health Radio, BBS Radio, Talk Radio New York City, as well as E360 TV. All these networks dedicated to empowering you to solve problems, uplift your spirit, and live a life of personal financial freedom. So you know what? We have Mike Hajjar. He's been wonderful, providing us some wonderful advice. And Mike, I just would like to talk a little bit more just for a few minutes about, why it's so important to have multiple advisors help you if you're making a mortgage decision.
Absolutely. So, one of the biggest reasons, right, is as much as I can maybe identify challenges. If a client comes to me and says, "Well," and we just had one yesterday. The client was referred to me by a lender who was not licensed in the state, and the lender calls me. He's like, "I structured the whole deal. Everything is great, good to go." But I'm not licensed in Michigan, and the client was supposed to buy in Tennessee. They ended up moving here. So I'm looking at the file and I'm like, why is this client putting 40% down? So I called the client. I said, hey, Joe, which is not his real name. Hey, Joe, I'm looking at your file and I just want to confirm a couple things. Are we putting 40% down because like you really need to be at that payment every month, or where did this 40% down number come from? He said, oh no, I was putting 20% down, and then because I have a sale of some land that's going on, I just figured I'd throw that on top of it. And I said, okay, if what you were to what you believed about money to be true may not be, would you be open, or how soon would you want to know? And while I can say, hey, it may not be the best to put 40% down, and that money could be better suited potentially sitting somewhere else. I can't give them the financial advice of where to actually put that money. So I would need to bring in somebody like yourself and say, hey, Steve, I've identified the issue, right? The issue is the 40% down. The client is very okay with making the payment with putting 5% down, what would you recommend? And is there a more efficient way to place this money where it will suit more of their long-term goals? Because again, the when I was at the conference that down in Orlando. Again, about 1,500 advisors, maybe about 7 mortgage guys. The number one thing that they talk about is, or the number one place that people are losing money unknowingly and unnecessarily is one, how they pay for their mortgage, the 15 years, the making extra payments, and the other place is the large down payments or making cash, these little emotional shortcuts. So, again, the importance of having a team of professionals is, while I can identify that problem, I can't legally say, and not do I, nor do I want to say you should put your money here or you should put your money there. That's not for me to say. That's for me to say, hey, you need to talk to Steve, and Steve can help create a more holistic picture, because the mortgage is only one vehicle in your whole picture. Now, then we may say, okay, well, we need to understand this client's got 9 properties, or 2, or whatever it may be. We need to understand the tax ramifications of some of the decisions that can be made, or the tax incentives based on what decisions can be made, and then we pull in the CPA for that, and then obviously in regards to protection and so many other things that I won't bore the audience with, is the importance of the estate planning attorney coming in, and again, without all of us communicating together, if the client goes to each person individually, if you think about the telephone game that we played in school, by the time one person says something and, in 5 minutes it's traveled across the room, the entire message has changed, not because somebody's wanting to intentionally mess up the message. It's just there's different ways of communication. But when we're all together, that's how we can actually serve the client the most, because we all don't know what the other professional knows.
Yeah, yeah, no, I agree with that because listening to what you said about that one scenario, it's like what we do. We say, okay, what's the short and the long on this? The short is where your assets going to be in the next 6 or 7 months or a couple years. But you know what? When you're retired in your mid 80s, where's your asset level going to be? Is it going to be down here because you made that decision, or is it going to be up here? Now, if it's up here, you can cover your healthcare costs, go have more trips, you can take your grandkids places, you can even gift them more by doing so. And you should be looking at whatever transaction you're making, especially if it's a large one. So
Absolutely.
I think that's wonderful advice to give anybody. Now, what are some of the other things that came out of the conference? Because I know that conference, you told me about the conference, you're dealing with concerns that have happened within your industry and how people deal with it. What are some of the best ways or the solutions that you that came up with?
Yeah. So what we so we have a heavy emphasis on the retirement side as well. Again, those decisions being made today, I don't care if the person's 25, 35, 45, 65, it doesn't matter. That's going to impact again. People are living longer, right? So when we're looking at these scenarios and we're saying, hold on, we know that your advisor probably, and I'm talking to any client that has a significant, maybe they have a portfolio of $1 million or 1.5 million, and the advisor did a great job growing it from there. But when we start to talk to them, we notice that some of these advisors really haven't, and I'm not picking on advisors. I'm picking on the system that's broken, in regards to mortgage professionals not knowing their own product to be able
Hmm.
to communicate it to a financial advisor. So one of the biggest things that we talked about there is the big bad reverse mortgage, right? And really debunking a lot of the myths around that. And one of the biggest things that we heard back from a lot of the advisors was that they had never heard it explained the way that we explained it. And I would opt to say that maybe 5% of mortgage professionals understand it at that level. So when we're dealing with we deal with a lot of seniors and getting into those retirement years. And when we're looking at some of these misconceptions, we've got about 13 trillion, I think, is the number now, of home equity for boomers. I think we've got like 10,000 people turning 65 each day, and they've done a wonderful job. And I don't blame them, right? Some and I'm not. This is no bash against Dave Ramsey. I'm just saying one of the things that he pushes is, pay the house off, make sure you have no debt, and own that home free and clear. We're okay with that ideology. However, there is a smarter way to own your home free and clear in retirement, and what that is actually putting in the reverse mortgage, because what the concept around that was that people thought that the reverse mortgage was only for destitute situations, loss of a spouse. And yeah, can it solve for things like that? Absolutely. But the number one utilizer of the reverse mortgage, or the HECM, the home equity conversion mortgage, is the mass affluent. People with 75,000 or more annually in retirement income, and over 1 to 1.5 million in assets. And you would say, well, that person doesn't need the reverse mortgage, and that's exactly where it comes in. So FINRA in 2012 had they really instigated the study, and it was done by people obviously way smarter than me. Dr. Wade Pfau, the Sachs
Mhm.
brothers. The American College of Finance, and what the study was, and they ran 10,000 Monte Carlo simulations on this and said, okay, before, the idea was that a HECM or a reverse mortgage was done as a last resort. Basically, draw the portfolio all the way down. And once that portfolio hits zero, then put the reverse mortgage in place. It doesn't mean that that strategy doesn't work. However, with all of those simulations that were run, it was proven, and this is, again, not what I think, this is just going to go back to the math, is that there's an 8x greater chance of cash flow survival when the HECM is put in earlier in retirement. So how we utilize that is there is a growing tax-free line of credit that compounds monthly at the same rate that the loan balance would be growing by. So when people think reverse mortgage, they think, oh, I have no mortgage payment, and then there's negative amortization. So, and I think this is the part where I say there's about 5% of mortgage professionals that really understand this. The reverse mortgage, when utilized properly, is one of the number one ways to mitigate sequence of returns risk. So, how do we do that? It's what's called a coordinated withdrawal strategy. That growing tax-free line of credit becomes a buffer asset that protects the client's current portfolio. So if you had a client and we've got a 30% down year in the market, well, we don't want to beat that portfolio up and then have to draw from there, and if they're obviously 72, then we're in an
Mhm.
RMD situation anyways, right? But we don't want them to have to draw from there if there is another tank for them to pull from, and that tank becomes the growing tax-free line of credit, which they don't have to qualify for once the reverse is in place. It's contractually guaranteed. Whatever they need will be in their account within 48 to 72 hours. And again, as we're going, so in a market up year, we'll say, yeah, let's pull off of, and we would sit with you, right? And we would say, Steve, I think, maybe do you recommend that we pull from the market this year? Yeah, we had major gains. Let's pull from there. Market down year, we pull from the reverse or the home equity conversion line of credit, allowing that portfolio to recover. And again, we start to talk about solving for things like long-term care, in-home care,
Mhm.
and all of these things that, like you said, we were all told at some point that we would be at a lower tax bracket when we got into retirement. I think that's very true for people that are retiring today, because we're in some of the lowest tax brackets historically
One
that
for
that
being.
we've been in, right? But we don't know what the future holds. So to create another bucket, what we tell clients is there ever a time that the same scenario where your home is free and clear, that it wouldn't make sense to have access to a tax-free line of credit, and that instead of, because what we see is people that don't put it in place when they need the money, well, now they got to refinance, but maybe they maxed out all their credit cards and they don't qualify, or they
Mhm.
lost a spouse and now the income doesn't qualify, or that, again, people are human. They forgot to pay the $30 Lowe's bill, and now they got a 30-day late on their mortgage. There's too many variables or intangibles that could cause somebody, forget real. I'm not even thinking about real estate market risk right now. Um, but what happens, and why I say real estate market risk is, God forbid, I don't believe that house prices will crash anytime soon. But again, that I'm not somebody who pretends to have a crystal ball from the short time we've been
Nobody
speaking
does.
together. So we really don't know what would happen. What is beautiful about that tax-free line of credit is that it grows independent of the value of the home. So God forbid we did have another 2008 and those values came all the way down, that tax-free line of credit will still continue to compound regardless of what's happening with the value of the home. So it makes a lot more sense on an illustration, but I think in its simplest form is at least start to get educated around those things. Anybody that is approaching age 62, we call it their reverse mortgage birthday, and it's not always the solution, right?
Mhm. Oh, it
Um,
never is.
but when we're able to pair it with, again, the entire picture, it can be something that it's a pool of money they didn't even realize that they had access to, and could potentially, again, too many market down years, we're dealing with a death spiral.
Yeah.
We start to look at mitigating sequence of returns risk with the home equity conversion mortgage.
Hey, Mike, I want to thank you for joining us today. How can people get a hold of you if they'd like your help?
So on Instagram, I am at Mike Hajjar underscore mortgage. That's Hajjar. And then everywhere else on social media, it's just Mike Hajjar, my first and last name. And our website is www.homeloanplanners.com. And also, they can find our YouTube or our podcast anywhere, the Financial Rebound. So any one of those ways, you'll get to me.
Hey, Mike, thank you so much for being with us today. The information you provided is invaluable to our listeners, and I hope you have a wonderful 2025. With that, I want to thank you for joining us.
Thank you so much for having me, Steve.
Oh, that's perfect.
Thanks, man. Yeah, it's hard to get that out without like an illustration, but hopefully I drove it home somewhat.
No, no, you did fine. You did perfect. You're good. You're good. I'm sorry to do this to you, but I got to run to somebody else. So I'm
No,
going to let you go. You have a good one. And thanks again for being with the show. You'll get a recording. You'll get the editor recording in about 2 weeks. Um, you will also get the show graphic and all that stuff. It's going to show, let's see, um, it goes to the radio stations in 2 weeks. It'll go to the syndicators in 3 weeks, which is 150 of them. And then it's going to go overseas and it'll air 6 times. We got a lot of expats overseas that'll hear it. So people hear it a lot.
I
So,
love that. I love
and then
that.
it'll go up on the website and we'll see how many times it gets listened to there. So,
Love it. Love it. I appreciate you having me. I'm looking forward.